Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hixon Zuercher Capital Management.
And I'm Josh Robb, director of wealth management at Hixon Zuercher Capital Management. Austin, how can people help us with our podcast?
Well, we would love it if you would subscribe if you're not subscribed already. That way you get new episodes every single Thursday when we drop them, and leave us a review wherever you listen to us. That way we can help more people.
That's right.
So today, Josh, we're going to be talking about what we're reading, because leaders are readers, readers are leaders. Leaders read, readers lead.
Yes.
Right. Did I say it enough?
Yes.
So we each have 3 articles that we found interesting and what we think about them, and we'll chat about them as we go along. Go ahead, Josh. Knock it off.
All right.
Knock it off. Start us
we
off.
We will link all these in the show notes for your reference. My first topic involves RMDs, required minimum distributions. And so again, as a high-level reminder, if you have an IRA or a 401k, any kind of tax-deferred account, if you hit the age 72 and above, you have a requirement that you have to take out a certain amount each year. But this conversation is around how you take them out in a down year. If you remember just a couple things, they actually recently proposed a life expectancy table change. It actually was a good thing. What the idea there was is they were changing how long they were calculating this because people are living longer. And so, in fact, it actually adjusted things a little bit. But what they found in doing so, they looked at accounts and how much people were withdrawing. And as the IRS is putting this together, they found that it's estimated that only 20% of people who are subject to RMDs take the minimum.
Gotcha.
So the 80% take more than the minimum.
Right.
Because that's how math works with percentages.
1 minus 20.
Yep. So the 80% though are taking more because they need it for living expenses. The concept there then is those 80%, they really don't care. They're needing it and spending that money. But for that 20%, and for those people who say, I have this required distribution, maybe it's more than what I need, or I don't need anything right now, but the market's down. And how they calculate RMDs is they take your beginning value or the ending value of last year, which is the same, 12/31 and 1/1, it's the same value, depending on looking at close of the one day or start of the next day. But the idea is that starting point is how they calculate your RMD for the year. So in a year like this year, 2022,
not a good year.
Not a good year. The market's down, let's just say 25%. And so the value it calculated on, and again, I don't know if everybody's IRAs are 100% in the stock market, but I'm just using these high-level calculations. But if your value is 25% lower than what it was at the start of this year, your RMD does not change. You still have to take that full RMD on the higher value they calculated
Even though you're pulling it out low.
Even though you're taking your actual withdrawal when you do it, let's say you wait to the end of the year, you're taking a higher withdrawal rate than they calculate on because it's on a lower balance at that point. By the way, just so you know, at age 72, the required distribution factor is 27.4, and you divide that into your amount, which means you're taking 3.65%. So we've talked historically that 4% rule is industry normed for calculating kind of withdrawal rate. Your starting RMD is below that. When you hit 80 years old, because it increases over time, it's a 4.95%, so 5% withdrawal rate, and then at 90, you're taking 8% out. So it increases over time, but your starting rate is below that 4%, which is why they designed it to last your lifetime. That to say, that withdrawal, whatever it is, if it was a 4% withdrawal to start with, if you're down 25%, it's a little bit higher of a withdrawal rate. So what could somebody do if they say, I really don't want to sell my stock and send it out of my account because I don't really need it, and I'm selling it at a lower point?
Not good.
So one thing you can do is you can do an in-kind RMD.
I love in-kind.
Oh, it's great. So in-kind meaning I don't sell the stock. Instead, what I do is, let's say I have an RMD of $10,000 and I don't really want to send out $10,000 and I don't need $10,000.
Right.
I could just take one stock in that account and send $10,000 worth of that stock, still holding the stock, into a taxable account, brokerage account.
Yeah, just a non-IRA account.
It's out of the IRA. I will owe tax on that $10,000, but I'm not going to pay it on that distribution. I'm going to pay it out of cash that I have. But in doing so, I can allow that stock to recover.
Yeah.
And I'll have only, whatever it is, whatever's down, I can allow it to recover. Down. And so I'm distributing my required distribution in my scenario, $10,000, and I could let it grow back up to whatever it was before, $12,000 or whatever. That's one idea. You still tax. You're not getting around the required distribution. The difference is you're just not selling it. And one thing to keep in mind is once you move it to the taxable account, cost basis matters.
Yeah,
which
cost basis do you use?
Correct. So cost basis, because in the IRA, growth is irrelevant. Cost basis starts at the distribution.
Gotcha.
So if I have a stock that's trading for $10 a share. Yeah, in a sense, it starts your calculation point at that.
Yep.
So if I have a stock that's trading for $10 a share and I need $10,000, I would take that many shares, put it into a taxable account. In that taxable account, the cost basis starts at $10 a share.
Yeah, not when you originally.
Not from the original, but that also means it's short term for the first year because it's starting at that point. Even though if I held that stock for 10 years in my IRA, doesn't matter. On that distribution, I have to wait a year before I get long-term capital gains, and any growth or loss will be calculated on the price at the distribution. Important that you make sure it's tracked that way when it gets over to that taxable account.
Yep.
That your custodian or whoever does that, they don't carry that cost basis over. But that's one way to do that. And in a sense, if you do get gains, you're only paying capital gains rates instead of income on that growth.
Yeah.
So just something to think about. Yep. So that was an article that for some people who don't need a required distribution, forced to take it. We talked about QCDs. There's other things you could do to avoid taxes. But if the taxes aren't your concern about recovery, this is one way to do it.
There are certainly opportunities that a challenging market environment gives you. This is one of them. Tax loss harvesting is another one, depending on your situation.
And
your advisor.
I will say, too, nowadays, most custodians, they don't charge a transaction fee for buying and selling. In a sense, you could sell in your IRA, send it to a tax broker and rebuy it. There's no there. All you miss on is how many days that it's sitting cash in between all those transactions. Yeah. So in a sense, you're doing the same thing. You're just moving it over in kind. But if you wanted to, you could sell, move the cash, and then rebuy the same holding, which then would start your cost basis at the exact same point. And that's all you're doing. You're just saving those steps of selling and rebuying. So that's the idea. Thought it was interesting.
That is interesting. All right, my first article is about Kim Kardashian.
Oh, yeah.
So admittedly, I don't keep up with the Kardashians.
That's true.
Which I think is the name of the show that made them all famous, right?
Yeah, Austin doesn't keep up with the Kardashians. Yeah. That's the show
exactly.
name.
That's the show.
Yep.
So news out recently. This is October 3rd, I think this came out. Kim Kardashian pays over $1 million, I think 1.3 actually, to settle SEC charges linked to a crypto promo on her Instagram.
Oh, boy.
Apparently, Kim Kardashian failed to disclose a payment she received for really pushing a advertisement for a crypto asset on her Instagram page. This is such an interesting precedent because if you notice, it was the SEC that she's paying.
Yes.
SEC stands for
the Southeastern.
yeah, that's right. Yeah. No, the Securities Exchange Commission.
Oh, yeah, that's right.
Keyword being securities. So the SEC is essentially took her to court to say you are promoting a security and you did not disclose that. The interesting thing is of how the SEC treats cryptocurrencies.
Yeah, they haven't defined it as a
They haven't
security.
defined cryptocurrency as a security. However, she settled already. So she must have felt like it could have gotten worse. So I'm just going to settle now. But with doing this, she also agreed not to promote any crypto assets for 3 years and to cooperate with an ongoing investigation, probably around other people doing the same thing. Actually, in June 2021, she was also in another similar heat with the SEC and regulators over a different post. But this is a thought that I had is cryptocurrency a security? As of now, the SEC has not defined that as that.
They said, no, it's not, but we will come after you for it.
It's just very confusing to me. So that's why I found it so interesting. Again, we'll link this article in the show notes as a CNBC article. The chairman of the SEC, Gary Gensler, his quote was, "This case is a reminder that when celebrities or influencers, which is not me or you, endorse investment opportunities, including crypto asset securities,
use the word again.
It doesn't mean that those investment products are right for all investors." Now, in her post, I saw a screenshot of it. It said #ad in it. So I think she was kind of trying to cover that being a promotion, but apparently wasn't enough to satisfy the SEC. But
oh, no, it's not. The marketing rules for our
here comes
industry,
our compliance officer.
Yes, the marketing rules for our industry are very clear on what you need to do when you are rendering some sort of investment advice.
Right.
And just saying this is an ad does not cover it.
Yeah.
And who you are, even if your job is not normally to be an advisor, if you put yourself out as a person who is giving advice or offering advice. And I saw her one Instagram post, but I guess you could say she touts that what she says is advice, I guess. And other things. So long story short, our industry is one you really don't want to kind of slip in and out of as a non-professional, saying, oh, I'm getting promoted, I'm going to push this or that. There's a lot of regulation you need to be aware of to get that done correctly and to not have this happen to you.
And it's a very popular thing on places like TikTok to be a influencer giving personal finance advice when you have no credibility whatsoever. So
now, personal finance advice is a little bit different than rendering security advice, which is where the SEC is mad at here, because she was actually mentioning cryptocurrency in this case.
Right.
I think it was, was it Ethereum? I don't even remember which one she was mentioning.
No, it was a new one.
A new one, okay. So in some of the TikTok ones, again, I'm not a huge fan of because most of their advice is kind of weird and out there anyways, is they're not giving individual security advice, which is really what the SEC cares about. Now, there's another marketing thing where you're rendering investment advice when it's financial planning, and that is a whole thing. But if they're clear that they're not a professional, or which usually you hear them say that in some way or another, and they're just giving an opinion on financial planning, that's a little different. There's a little bit more wiggle room there. But when you actually mention something that you are talking or encouraging them to buy, that's where the SEC is really going to pay attention.
So I guess my takeaway from this whole thing is cryptocurrency a security or not? The SEC wants to regulate like it is, but thus far it's not.
Yeah.
Also, I think Kim Kardashian has a net worth of like $1.3 billion. So I don't think she's going to be feeling
what was
too
interesting
much on this.
Was I think she only got paid. How much did she get paid for this? It was less than $1 million. I know that.
So she lost.
I
money
saw
on
it.
the deal.
Well, that's what surprised me is the penalty of the SEC wasn't just you have to pay back what you got. It was we're going to penalize you for doing this. So that was what was interesting to me. It was I feel like she got paid like $200,000.
It also probably depends on when she did the promo because if she would have before the crypto world fell apart done that, she probably would have just lost a bunch of money on the whole deal.
Oh yeah.
All right, so that's my first article. Josh, what is your next article?
All right, so let's talk about Medicare.
Oh, you had
Medicare.
We were talking about RMDs. Now we're talking about Medicare.
I mean,
You're just ticking all the boxes.
Oh, this is exciting stuff I read.
Yep.
Amazing stuff. The Department of Health and Human Services.
DHS.
Yes. Part of the Center for Medical and Medicaid Services, which is the larger grouping. Long story short, they're the ones that decide how much you pay for your costs. They just came out and said that Medicare Part B, which is the secondary, so Medicare Part A, if you qualify for Social Security, is included. There's no premium for that. Part B, there is a premium. They're actually going to be cutting the premium.
Wow.
Which is crazy when you think inflation is 9+% this year for all the different things.
Just get charged less.
They're dropping 3.1% for next year.
Wow.
Yep. So you're going to go from $170.10 to $164.90. That's the average cost.
Per month.
Pretty good deal for people on Medicare. And the deductible is also going to go down about 3%. So not only your premium, but your deductible is going down. So that's great news. This is only the third time since 1965 that Part B premiums have gone down.
Wow. Third time. That's a long time.
Now, they mentioned the reason for that is in 2023 that premiums are going down because spending on the new Alzheimer's drug and other types of care turned out to be lower than they anticipated. And so they set the premiums on what they expect the next year costs are going to be because Medicare is supposed to not be making any money. It's a government program. So if it's lower, they adjust it for the next year, which is great. But again, historically speaking, this is the third time since 1965. But for anybody on there, that's great. Now, Medicare Part A, if you don't qualify for it to be free, those premiums are going to go up a little bit because those costs have not seen a reduction.
So, Josh,
yes,
that's fascinating, but I have a dad joke of the week for you. I think you're going to like this one.
I'm ready.
What kind of insurance would Moses have if he was still alive today?
Oh, man. I'm not sure. What would he have?
Medicare Part C.
Oh, Part the C. I get it. Part C.
See, I had to follow the Medicare discussion up with a Moses joke.
I like it.
All right. The next article I had was from Bloomberg, linked in the show notes. Probably a paywall, so sorry if you can't access the full version. But titled, Work from Home or Return to Office. A rift is emerging among U.S. workers. There is this tension between go to the office and work from home amongst not just United States employees, but employees around the world. There was a big survey done, 3,500 people, commissioned by a company called Good Hire, which is a firm that performs employer background checks. They found that almost 3/4 of respondents said companies should pay in-office employees more than work-from-home colleagues.
Interesting.
And 2/3 are concerned that managers view full-time remote workers as lazier. So those are statistics based on that pretty sizable group of people there. At the same time, a third group of respondents are willing to quit their jobs or start looking for a new one if forced to return to the office full-time. Now, that share is down from last year, which underscores a growing pressures in the workplace to get back to the office there. A majority think that work-from-home employees will be more at risk to lose their jobs in a downturn. And both camps agree on one important matter. Working remotely will probably hamper their career.
That is interesting. So all those people are agreeing on that piece.
Yes.
But yeah, a group of them
still will do it
is
and
saying,
will threaten to leave.
A third of them will say, I will leave if I have to come back.
Isn't that crazy?
Even though I know my career could be hampered from me working
now,
at least part-time. Now, a follow-up with that, while you're thinking about what you're saying, I saw an article that talked about Fridays being one of the ideal times to be working in the office, which seems counter, like why would you could have a longer weekend without the commute. But the reason when they talked to people was less traffic, because a lot more people are taking that Friday to be a work from home day. Fewer people in the office, so you get more done even though you're there.
Yep.
And less demand on like the office printer, things like that, where you can just be more efficient.
Yeah.
I thought that was interesting.
You flip it. If you have that opportunity, you take Mondays as your work from home day and you work the last one.
I saw that as part of this. I thought that's interesting.
That's interesting. I mean, during COVID, we worked from home for a short period of time as we were required to or whatever. And, there for a little while, it was semi-convenient to do this or that. But the productivity levels being in the office is so much higher. So I can see how people could think that people are slacking when they're not there because, man, you just got to come to work every day and do your thing, and that's good. It's also a lot easier to separate work and personal stuff when you have that separation. So, I don't know. I like being back in the office. I know that a lot of the places around here are mostly back now. I think even Marathon Petroleum, really close to where we are, they have most people back to the office most of the time. But some of those bigger companies, it's taken a while to get people back.
I will say my mindset has changed a little bit on this in that if you're in an industry or your job in particular can be measured very efficiently on what you get done and what your role is and what your expectation is, where you work can be very flexible. If you have a job where you can easily measure, did you get your work done?
Right.
And hours are irrelevant, but product is there. Then whether you work from home, whether you work in an office, whether you work 9 to 5 or middle of the night, as long as it accomplishes that piece, then I think it's irrelevant. But the hard part is that not a lot of jobs are like that, right?
True.
I like my job as a financial advisor is I have to meet with clients. And so you can do that remotely for those that want to do a Zoom or Teams or anything like that. But for those that want to meet in person, there's only one solution to that.
You're not going to have everyone over to your house?
And the same is true. I mean, obviously, any kind of service industry, the service is the tangible piece there, right? But I'm sure there are a lot of jobs out there where you could not only do it from home, but you could do it very efficiently in not a traditional 9 to 5,
right?
Which is what a lot of them were wrapping that into, with a lot of probably dead time in there if they were very good at their job. So my thought process is it's not a across the board thing, but I definitely agree when culture matters, when teamwork matters, in person just seems to be the ideal way for that.
You can collaborate so much easier. Just pop in to the office and have a question or whatever. Just it's a lot different. So anyway, I thought that was very fascinating. Josh, what is your third and final thing you've read ever?
All right, this is it. The final one. This is about millennials.
That's me.
And the Gen Zers. Those youngins. But this was done by Orion Advisor Solutions, which they are a platform. They're in our industry. They have some software that people use. But they did a survey. It's the inaugural Mind and the Market Investor Sentiment Survey, which is pretty cool. I don't know what all they asked, but they had 500 U.S. residents with an annual income of more than $150,000. And of those, half of them are pessimistic about the country's economic outlook.
That's half.
Yeah. And 52% are pessimistic about the global economy over the next 6 months.
So that's half.
Yeah. So about half the people they surveyed are not optimistic. Now, despite that, 82% of millennials have a positive mind frame on their own financial future.
Define financial future.
That would be, how do they feel that they're doing and how their progress is. That takes those two. They're part of that 50% that are pessimistic. And so this survey shows that along with that, not just the millennials, but millennials and investors who work with a financial advisor are generally more optimistic about their own financial future, the U.S. economy and the U.S. financial markets, than any other group. But this is the key. When they broke this down, millennials may be pessimistic about where the economy is in the next 6 to 12 months.
Right.
But what they're seeing is, especially those that have an advisor, are saying, it's okay. Because
don't worry about
I'm
it.
adding in, and they get the idea of, I'm not touching this money. Millennials are not retiring anytime soon. And so they're looking at this as an opportunity, whereas they can still be pessimistic about where the market and the economy is, but it's not driving any kind of
long-term
fear of where they're at or their ability to accomplish their goals. In fact, there's quite a few of them that are actually optimistic because they're saying, hey,
this is a great opportunity.
This is a downturn. I'm adding money. This is awesome. The cool thing there is it turns out millennials, especially this is people with an annual income of over $150,000, they're the ones that have the cash flow to be adding significantly to their retirement plan. For an advisor to see this, it's like, okay, this is the opportunity that a lot of these millennials haven't experienced yet. 08, 09, millennials were not savers at that point. They probably were still in college or even before college at that point based on the birth dates. And so this is really the first prolonged downturn because COVID was such a short downturn. They really didn't have time to think or adjust their savings or have to contemplate that spending. Now they're seeing, we're in month 9 of this downturn. I think August was positive, but other than that, we've seen a downward movement this year. And so millennials are finally getting a chance to put into practice what they've been taught if they have a financial advisor or have been taught that downturns, while you're saving money, are a good thing.
I would say that the statistics from that same survey taken for people who want to retire in the next couple years, probably quite pessimistic.
Yeah, and I mean, you look at that 50 to 52%, half of the people surveyed are not optimistic about anything.
Yeah.
And so that being the case, if you're not optimistic about everything going on around you and you're looking to make a financial life change, you're not feeling good about it right now. And you need to be talking to your financial advisor about how that impacts you.
Absolutely. Well, my third and final article is titled, it's also from Bloomberg, linked in the show notes. Again, sorry for the paywall if you have one. Good article, though, titled U.S. Home Prices Now Posting Biggest Monthly Drops Since 2009. Median home prices fell 0.98% or 1% almost in August from a month earlier, following a 1.05% drop in July. There was a mortgage data provider called Black Knight. They're the ones that put together all this data there. These two periods mark the largest monthly decline since January 09. So kind of like, it was before the market bottom in terms of the stock market, but things were definitely falling apart from a real estate situation at that point. The housing market, losing steam fast with skyrocketing mortgage rates driving affordability to the lowest levels since the 80s. The Federal Reserve has sought to curb inflation, which has thrown cold water on the U.S. real estate boom. So if you think about home prices in general, they're falling over a month-over-month basis. They're still significantly higher than they were a year earlier when the buying frenzy was going crazy. So values are still up 12.1% from a year earlier in August. Now, at the peak of all this, home prices were up like 20% year over year, which was obviously
crazy,
unsustainable.
Yep.
But it's not just buyers who are stepping away from the fast-cooling market. The doubling of mortgage rates, so remember, they're at like 6.5.
6.5,
yeah. For a 30-year right now, that's twice what it was a year ago. This is disincentivizing would-be sellers because
why would I lock in
I lock in a new rate if buying a new house at a very high interest rate and prices are coming down? Why would I take less money than I could have a few months ago? So inventory was on the rise from May to July. It stalled in August. So that is going to put, the real estate market is not it's not the place to be right now.
Yeah.
Things are slowing down very quickly in that area.
What I would love to see is new home builds start, because we've seen lumber come back down.
Lumber's pre-COVID levels.
Yeah. So hopefully we'll see some entry-level houses being built, because that's who's missing out on this, right? Is these are people moving from one level to the next level.
Right.
And we just know historically, since 2009, we have not kept up with new home builds to offset the demand. And so if there's a slowdown in people transitioning homes, I'd love to see new homes help backfill some of that in so that we're a little bit more normal housing market in general.
The statistics that I am shocked by, which kind of pre this slowdown, were things like, okay, so your mortgage rate is double what it was last year. Home prices were up 20% year over year at the peak. So you combine those two things together, and assuming a 20% down payment, your mortgage payment for the same house at the peak versus the year before is double.
It's crazy.
In a year. So like that's housing inaffordability.
Yep.
You can't sustain that. And that's why no wonder people aren't moving.
Yeah.
Like if you're locked in, especially if you refinance
3%
coming out of COVID or whatever.
Under 3.
Oh my goodness. You should not, this is not the time to move unless you're just flush with cash.
Or there's a life change that makes you move.
Yeah, exactly. And think about the negotiation power you have if you're like being relocated. Be like,
I have a rate here. I don't want to move from.
This is my house cost and my rate and my mortgage. This is what I'm going to have to take over here. So I've got to capture that.
Listen, Kim Kardashian told me.
Kim Kardashian told me. Josh, you clearly are keeping up with the Kardashians.
She said, don't move.
So that is what Josh and I are reading. It is a fascinating environment out there, a challenging one. But there are glimmers of hope in certainly of these areas. And, while the market's been challenging, we want to point out that it always has recovered in the past. Stocks are down, bonds are down, but really your forward returns from this point, historically speaking, have been quite favorable. Again, past performance is no guarantee of future performance, but it should, similarly move in a similar direction. So we're optimistic about the future. We're cautious and, trying to understand what's going on and what we're experiencing right now. But we're here for you guys as listeners. So if you have any questions, please email us to hello@theinvesteddads.com. Or if you have someone who is asking about some of these topics we talked about today, share this episode with them. Hopefully they will be able to learn something.
Oh, by the way, our Invested Dads stock draft is still going on.
It's still going on.
Still going on.
You might beat us.
Yes, but check out on our website, Facebook. There's all the links to get there. There's a password, donuts for life, the number 4. But you can still sign up.
Yeah, it's not
the
too
markets
late.
are down, so you could jump in and get some prices good if you hadn't already locked in. So just wanted to throw that out there. It's still available if anybody wants to join us.
Great. Until next Thursday, have a great week.
Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.